So I'm going to talk about our CPC program, which is our Capital Pool Company program, which is a uniquely Canadian listing vehicle that helps earlier stage private companies go public through a two-step process. In a CPC, experienced founders form a shell company with no assets other than cash and listed on the TSX Venture Exchange to raise seed capital. That public shell, called a CPC, then seeks out and merges with a private operating business in a qualifying transaction that we refer to as a QT, effectively a reverse takeover, allowing the private business to access the CPC's funds, shareholder base, and public listing. After the QT, the combined company continues trading on the venture exchange as a normal listed issuer. So why a CPC and not a traditional IPO? Some companies prefer the CPC route over a traditional IPO for several reasons. Unlike an IPO, a CPC offers greater flexibility, certainty, and control over timing and pricing. Since the CPC is already a publicly listed company, the process for the RTO could result in less regulatory rigidity, which can make the process faster and simpler. In practice, this means a private company can work more closely with a small group of investors and directors to tail the transaction rather than conducting a broad underwritten offering. Some of the advantages of doing a CPC are, for one, gaining an experienced management and board. By design, a CPC will be created and led by seasoned directors and officers with public company experience. Through the QT, a growth company gains these long-term professional investors as new directors and shareholders, helping bridge to public market standards. Second, getting access to capital and liquidity. The CPC first completes an IPO to raise a pool of cash. This ensures funds are immediately available for the qualifying transaction and gives existing shareholders liquidity without needing a full IPO. In fact, once complete, the CPC raises this pool of capital specifically to fund the acquisition of a target company through the qualifying transaction process. Lastly, there is a mitigation of IPO risk by doing a CPC. Because a CPC can raise money without a broad public distribution, some market risks of a traditional IPO are reduced. Since the CPC already went through an IPO process, including getting the requisite number of shareholders on board, the process to raise capital for the RTO can be much more straightforward. The CPC program has a strong history in Canada. Since its inception, over 2,800 CPCs have been created on the TSX Venture Exchange. About 85% of those CPCs successfully completed a qualifying transaction and became operating public companies. Collectively, former CPC issuers have raised over $83 billion of equity at the end of 2024. And about 1/3 of all venture companies that graduate to our senior Toronto Stock Exchange began their life as a CPC. These statistics underline that the CPC model is the most common way to go public on the venture exchange. In 2024 alone, former CPC companies raised around $2.2 billion of new capital in their public growth stages. In fact, 40% of new listings on the venture in 2024 were CPCs, reflecting the popularity of this route. In short, the CPC program has an incredible track record and has helped many startups become established public companies. Forming and listing a CPC involves a few key steps to ensure credibility and public float. First is the seed capital stage. The CPC founders, their directors and officers must invest personal funds into the new company before the IPO happens. Current venture rules require that at least $100,000 or 5% of proceeds, whichever is higher, come from the CPC's directors and officers, with each of them investing at least $5,000. the total seed financing can be up to $1 million. For example, an illustrative CPC might have 3 founders, each investing $35,000, and an institutional investor adding $125,000 for total seed capital of $230,000. We'll show this hypothetical example in a later slide. This aligns with the venture's requirement that seed shares be issued at a minimum price of 5 cents or 50% of the IPO price, whichever is higher. The next step is the initial public offering, the IPO. After raising seed capital, the CPC conducts an IPO. The minimum share price of the IPO is 10 cents per share, and at least $200,000 of funds must be raised, with a maximum of $9.5 million in this round. In practice, many CPCs may raise only a few $100,000 in the IPO, enough to cover its share of the expenses connected with the next stage for listing the qualifying transaction. As we will show you in a subsequent slide, an example of a CPC that raises $300,000 by selling 1.2 million shares at 25 cents. In that example, the combined seed and IPO proceeds for a CPC can range between $300,000 and up to $10 million. Note that the CPC will meet the regulatory public float requirements. The IPO must create sufficient public ownership. The CPC needs at least 150 public shareholders, each holding at least 1,000 shares, and at least 500,000 free trading shares by float. But since the post-qualifying transaction actually requires 200 shareholders, many of the CPCs will still sell their IPO to 200 shareholders in the IPO. In other words, at least 20% of the shares must be in public hands. That's the 20% public float standard, which is a venture rule. These rules ensure that after the IPO, there is real liquidity and a base of shareholders. As discussed on the previous slides, the CPC program is essentially a 2-step market entry. Step 1 is the CPC formation and IPO. A CPC is formed by veteran directors, raises seed capital, and completes an IPO on the TSX Venture Exchange. At this point, the company is publicly listed but holds no active business, only cash. This stage connects the company with Canadian investors and provides working capital for the next phase. Step 2 is the qualifying transaction, otherwise known as the QT. The CPC then searches for a suitable private business to acquire or merge with. In this QT, the private company effectively acquires the CPC via a reverse takeover, otherwise known as an RTO. The operating private business is combined with the CPC, and the CPC's cash is used to provide funding along with any new private placements to the combined entity. Once the deal closes, the combined business continues trading publicly under the CPC's listing, but with the private company's operations as the core. Often the ticker will change to reflect the new operating entity. After the QT, the CPC's original cash balance has been invested in the acquired business, and the board is typically refreshed to include representatives from both parties. Crucially, the shareholders of the private company usually become the majority owners of the new public company, preserving control. In other words, the private company's shareholders access the capital, shareholders, and expertise of the CPC to complete a listing while retaining a controlling interest. The CPC's founders and seed investors take a smaller percentage of the new entity in exchange for providing the listing vehicle and initial capital. There are 3 concrete groups of shareholders in a completed CPC. First are the CPC founders and the CPC's IPO investors. Let's call those the CPC investors. Second are the current shareholders of the private company that is looking to complete an RTO of the CPC. Third are the new shareholders that invest in the new entity formed by the combination of the CPC and the private company. After the transaction is completed, the CPC founders may own anywhere from 1 to 10%. This slide shows 5 to 10%. However, the actual split can be much lower in many situations, especially when a lot of new capital comes through the financing from the qualifying transaction. Throughout this process, typically the private company's ownership carries forward, preserving control. The CPC's funding and public status are used to fuel the business, and additional capital can be raised concurrently by bringing in arm's length investors. The concurrent financing, so after the QT closes, the CPC structure is dissolved in name and the combined business simply trades as a normal venture issuer. Earlier, I referred to a sample transaction structure, so I'm going to show you a hypothetical one here where this could be typical or not so typical of a CPC transaction. Here, in the seed financing stage of the CPC, 3 founders each buy 280,000 shares at 12.5 cents, otherwise spending $35,000 each in Canadian dollars. And an institutional investor participates in that round, buying 1 million shares at 12.5 cents as well, for a purchase price of $125,000, totally raising $230,000 in seed capital. That satisfies the founding investment requirement. In the CPC IPO stage, this hypothetical CPC issues 1.2 million new shares at 25 cents, raising $300,000 more. So after the IPO, the CPC has issued 3,040,000 shares outstanding and $530,000 in cash. In the qualifying transaction stage, in this example, a private company valued at $30.8 million merges with the CPC and then does a concurrent $10 million private placement. The result is a new public company with about 139 million total shares. In this example, just under 74% of equity is owned by the private company shareholders. Just under 24% is owned by the new investors in the qualifying transaction, and only 2.2% of equity is owned by the CPC founders and the CPC's IPO investors. So this preserves control for the original business owners while providing significant new funds for growth. So I'm going to conclude here and just say that the TSX Ventures Capital Pool Company program offers an established, flexible way for private companies to enter the Canadian public markets. It provides immediate capital and experienced directors while allowing the company to keep majority ownership. It helps manage the costs and complexities of listing, often lower than a traditional IPO, and mitigates certain risks. The program also has a strong track record on the venture exchange with about an 85% success rate, leading to qualifying transactions, and has raised over $83 billion for these CPCs. For those considering growth capital, the CPC route should be viewed as a proven vehicle for scaling. The structure of the QT transaction ensures continuity for the operating business while opening access to North American investors. For those interested in pursuing this strategy, we can help you connect with Canadian Securities Council, financial advisors, and CPC partners to help you begin preparing the required documentation and to start the process.